Thanks for joining us. Another month's gone by, and we've got a number of issues to talk about, and even a special guest star to add some real industry nous to what's going on in a really relevant issue, really relevant industry, particularly with getting Christmas presents organised and whatever else is we're all turning our mind to now. We have our schedule of experts internally and our special guest star, and we've got an interesting discussion topics, all which seem to lead together at different stages today. So we'll get through those and hopefully give you some interesting things to think about going forward. In terms of the discussion topics, I'll take you through a sort of feel of what's happening with retail and some of the challenges that they're going through. And the leap, I think, is coming over the next 2 to 3 months, particularly with the bargain opportunities of cyber frenzy that's on now and a few other things coming up. Then we're going to get Betty to give us an update on everything, something that's close to everybody's heart in Sydney, which is property lending and mortgages, just to see where that's going and whether it is time to lock in and whether you've missed the boat. Then there's the big issue that is challenging a lot of businesses at the moment around supply chain, along with staffing issues. That is a massive issue to manage and also impacting pricing and whatever else. And then whether there is any succession plan sort of positioning now and how people are dealing with these things. And the final thing, which is always critical at this point of this time of year, with lots of leave coming up and having to pay for that leave out of cash, is making sure you have cash flow right. So we'll get into it. So Black Friday, we'll get to shortly. So here we are with just a sort of review of retail turnover. There's been a strong upward trend actually through July, August and September, which is surprising given the lockdowns. And it would not be surprising if there's a massive leap in October and November as everybody's been let out and been able to spend money. The issue will just be where the pent-up retail demand deploys. Obviously, there's a lot in hospitality as people haven't been able to go out. And as I've been told by a number of people, they're sick of cooking. So they just want to go out and try different things. There was 25% sort of jump in April 21. I wouldn't be surprised if it's similar to that sort of level. And that would have a massive impact coming up to Christmas. The issues I think around that is can retail get enough people to be able to do it, which seems to be a real problem for them at the moment because people have moved out of that sector and gone into other things. And the other counterbalance to that is online sales events are just snowballing over the balance of November and into December. So there's positive signs, but there is some limitation. And the other limitation is obviously a supply issue about getting actual stock into the country, which is a lot more difficult than it was 18 months ago and 2 years ago because of issues outside of Australia. And that's impacting pricing as well. So this is probably one of the major bounce areas outside of hospitality. If you look at the clothing, footwear and personal accessory retailing, and you can see from what's in Click Frenzy that this is probably one of the areas which is really deploying its guns at the moment with 50% off offers everywhere. And the other issue is that spring through to December is traditionally their best time of year to make margin. Generally at this time, they are charging full margin from September as they release their spring collections. There's always the new iPhone comes out in September as well, and that drives their turnover. This year, in a lot of sectors, Apple aside, their sales have probably been damaged by lockdowns and their full margin sales have been damaged. So that will impact how they approach it going forward. Overlay that on top of the challenges with stock and staffing and delivery timelines, it's a very complex time for this sort of fashion and footwear industry to be able to look at. And there could be some decisions which are really lucrative and there could be some that are less so, because I think they're all moving from probably having a order and drop sort of scenario where warehousing has become reduced. And now there's a sort of requirement at the moment to have interim warehousing to make sure you have stock available if you do well. Next one. This is an interesting one because this is specifically around department stores. And if you look at the change there, I mean, I know it's not that material, but it is still significant. And it didn't change pretty much in August, September, whereas the other sectors have. So how do these department stores position themselves moving back will be interesting. They are also a critical part of the retail and fashion industries in that they are a holder of brands that can distribute volume through those brands effectively as a wholesaler, which underpins and effectively pays for everything that the brands in their cost base, and then they can actually run into other stores and whatever else of themselves to make profit. So if there is a restructure of these entities, that could create some real concern and issues across the industry and might create some waves where other retailers may be under pressure more than they are at the moment. So I think that's an interesting area to watch and consider how that's going to impact clients and whatever else along. I mean, there has been a pivot, sorry, Tanya, there has been a pivot in the UK, and some of their department stores have pivoted and been really successful. That is in a different market to what we have, and there just needs to be a real, the most difficult thing is trying to find that way to the customer and bring that thing back, particularly where the department store clients have been, or customers have been historically older, and a lot of their customer base is probably in the final throes of their period on Earth. So how do they go back and find some younger demographics? And here's the interesting stuff from people who want to spend money. So Click Frenzy started last night, 53 hours. So get involved there. I've already had 2 or 3 of our guys in my team telling me about some of the offers and the schemes that they're running to maximize the value they're spending. There are some good deals, and this is obviously a more Australian sort of structured thing. Singles Day happens later in this week, which is an Asian sort of phenomenon. And then we have Black Friday at the back end of the month and Cyber Monday, which are based out of the US and have been going for hundreds of years, but now are really a focused process. And one of the things I understand from talking to a few of our customers is that they plan specifically for Black Friday. They have Black Friday stock, they have Black Friday offers, and the same with Cyber Monday, if that's where their customer base is. So that's a really good opportunity if people want to buy things for Christmas, subject to them being in stock and being here. And I think we'll hear from our special guest around some of the issues that are facing getting that stuff in, and Nick, which probably means that, and I suspect we're going to get told, that if you want to buy things for Christmas, you probably need to start looking at it now if it's going to get delivered from somewhere outside of the country. The other thing that's interesting here is that now, as I was talking about before, there used to be full margin on retail from September to, say, early December. Now there is no full margin period this year because of lockdowns ran into October, and October was therefore effectively a discount month to try and get people back into store to buy things. So there'll be a lot of retailers that have been selling things but might not be making the margin they normally do in their best period of the year, which is September to December. So it could be unstable in that industry going forward. We always like to ask an interesting question. And for some of the people, particularly some of my older clients, I've put D in here in the poll question. So are you going to spend more than last year, less than last year? It'll depend on the offers. Or, and as I asked one of my other clients this morning about Cyber Frenzy and Black Friday and Cyber Monday, he went, what are they? So it is generally a more millennial and social media sort of driven thing. So people who are in touch with those aspects are generally more active in these parts of it. So we thought it'd be interesting to see how this breaks down. What do you think, Ashy? Are you going to spend more this year?
Probably not. I think I'd probably be consistent with previous years, to be honest, which isn't a lot, to be fair.
Well, you're a very careful accountant.
I'm a very careful accountant, so maybe not I might not be the target.
So further on from that, then we look at the labour force key statistics, which sort of plays against what we were just talking about as well. So this is the crosses and the ticks are comparing August and September. So unemployment rates actually went up. Participation went down. Employment decreased, and employment ratio decreased. So they're all negatives, albeit they're somewhat marginal. But the two big ticks I look at are really the bottom two. And if you look at the hours worked increased by 15 million hours, that's an indication that the recovery has already started and that people are now actually working hours rather than just being employed. Because previously there was drops of 60 million hours, even though unemployment hadn't changed, because of the government support was keeping people employed, but they actually weren't working hours. And it having actual hours work means that people are paying tax and people are actually going out and doing things, spending money to get to work, spending money at work, and all of those things, which should drive an increase. So all of those things are actually probably positive, because the unemployment rate was closer to 9% once you actually broke out the people who were employed but not actually working. Now we're getting closer to being able to understand where it's actually at. And if you look at a leap in retail, as we just talked about going forward, there's a big opportunity to utilise some of that underemployment that's out there and bring that unemployment rate down until borders are open, and we get an influx of people who we can also deploy as well. There is pressure on wages as costs are going up on basic things. And we all know what wage increases mean, which that always leads to that wonderful inflation thing, which drive interest rates. But listening to economists at the moment and the RBA, there is a major disagreement between the RBA's view, which is wage growth is not going to happen until the back end of next year, whereas everybody else is saying pretty much consistently that they see it now. And that's part of what we get to in the next couple of slides. If you look at the labour force, so this is more of an indication of, I think it's more reliable of what unemployment looks like and how people are actually working. As the support finally removes, even in Victoria, there is a likelihood of increasing unemployment for a short term, and then probably that will change as there are short-term roles leading up to Christmas and retail restarts and hospitality restarts. But we do have an underlying lower workforce without international students and people coming into the workforce from overseas that we normally would have. And that's something we're going to have to deal with until there is sort of clarity around how that moves and how that works. Even in our business, we're struggling to recruit certain types of people, particularly auditors. For some reason, that's just a worldwide issue. But there are other gaps in other parts of the business. So that's going to be an ongoing issue going forward. This is a really interesting sort of thing. So if you look at that, as we're talking about, the hours went up. So that's 1.875 million 8-hour days, 15 million hours. So that is a material change. And there's real work rather than the employment, and the expanding opportunity should materially increase hours. So if you look at where we were back in March, there's a big gap in the hours worked sort of position. So that should really drive some growth back up, and the leap should happen relatively quickly. And more people earning money again and working will obviously drive the economy relatively quickly. We should get a real big bounce as we did last year. So we asked this question last month. We'd also like to ask it this month, and we'll flash up and compare what's happening. Recruitment retention is obviously a major issue, and a lot of people are having to spend a lot more time and more money to be able to get a person to do a number of the roles they have open. So it'll be interesting to see how this populates, given that last month, 43% were having to offer more money and spend more time, and 38% it's difficult given the uncertainty and we're holding off. So it'll be interesting to see how that has moved over the past period. So that means that there's a movement towards B, which says to me that the economists are not wrong, that there's going to be wage growth, given that people are going to have to spend more time and more money to get people to cover off on these roles that they have. So in summary of encapsulating all of that. Retail is about to leap. The question is how far and who's going to miss out on that jump. So some of the retailers will miss out just because they've got the wrong stock, or they just can't get the offering, or they can't get it in. I think there's going to be a limitation on that supply and their staffing available. There's still so much money around that there's a really great opportunity to be able to borrow. And you've seen how many deals have been done. I think there was 7 deals announced on the ASX on Monday of close to $5 or $6 billion just for people buying other businesses. And staffing remains important because that allows you to execute. So that's going to be an ongoing issue until there's a bit more clarity around borders. And inflation is coming. And Betty will talk about rates and how rates are changing on loans very shortly. But I think that's one of the driving factors that we're going to see over the next 18 months. So let's talk to these experts, including our special guest, around how they see things going and what are they seeing in their specializations. First up, we have Betty. And Betty's our expert in home loans and finance in our HLB debt advisory. So she lives and breathes these types of deals, and she can tell us exactly what's happening in the market.
Oh, thanks, Todd. So we can all agree that we are at the bottom of the interest rate cycle. We've had 11 years of decreases in the cash rate. So we can't, and following from the RBA's decision last week to not move on the bonds, the banks have subsequently gone and increased what was substantially low fixed rate loans. So fixed rate loans in the past few months have had a 1 in front of them. You could probably score a 1.89% fixed rate for 4 years a few months ago. There's a couple of lenders still out there that are offering some super sharp 1.99% interest rates, but the majority of our home loans are now in the 2s. So we still are at a super, super duper low interest rate, home loan interest rate at the moment. In fact, I've got a slide here that details some of the sharpest rates on the market. I've just put in there the 86400 product because it is one of the sharpest rates on the market. But as you can see, it's a 1-year fixed rate and it will revert following the 1 year to 2.44%, which is probably not one of the sharpest rates on the market. It's still a super sharp rate, but not the sharpest. I should mention this slide, the assumptions are that it's $1 million home loan, that it's for owner-occupied purposes, and the loan-to-value ratio is 70% over a 30-year loan term, and it's principal and interest repayments. So what can I tell you? This is a good slide that details what the sharpest rates on the markets are, what the repayments would be on a $1 million loan, what the features are. There's a common misconception that refinancing your loan or discharge, is a costly process. This is not true. It is refinancing your loan can be a very smart strategic decision to make financially. And in fact, most discharging your mortgage from one bank and registering it with another bank costs around $700. The only exception there is if you do fix your loan, which in today's market would not be a silly thing to do, to take advantage of the sharpest rate, say a 1.89% 2-year fixed rate with ING, which is probably one of the sharpest fixed rates on the market today. The majority of them have got a 2 in front of them. You are entering into a contract with the bank for that fixed rate period, and you cannot deviate from that contract. Any extra repayments you make cannot be greater than $10,000 per annum. So if you're planning on, making a bulk reduction within your fixed rate period or selling your property, you would not be fixing your home loan. But if you don't think you're going to have any changes over the next 2 years, then fixing your home loan is probably a good time. It's probably a great time to be fixing, because we can all agree that next year is probably when we'll see the rates will be increasing, and we'll start to finally see the cash rate moving from the 10 basis points that it's currently at.
So in other words, if you want to get a loan with a 1 in front of it, you need to do it before Christmas.
Absolutely. I would say yes, 100%, because I think that the 1 in front of it home loan is slowly going, and it will certainly be a thing of the past. Yeah.
And although some of these are attractive, and there are other offerings like Athena out there, but they are a relatively simple product and have higher restrictions on an LVR and all of those things. So they're not as simple as they sound, although they're advertised very well.
They are advertised well. So Athena is a very clever product. It's clever advertising. It's a product that most lenders have anyway. It's pricing on loan to value ratios. So Athena's sharpest rate, in order to qualify for their sharpest variable rate, your loan to value ratio needs to be at 60%. A lot of the lenders are doing that. So if you've got a really low loan to value ratio, then you can qualify for one of the sharpest rates on the market. Athena's product is also a basic home loan, so it's a no frills loan. So there is no offset account. This is their variable rate product. They do not have an offset account, so there's no fees and charges applicable because it's a basic home loan, no frills loan. And again, a lot of the lenders have got that as well. The majority of lenders all offer no frills loans with no fees and charges. So it's just clever advertising when it comes, the past couple of years we've heard about the loyalty tax that lenders impose on customers. That's certainly happening today and is continuing to happen. And I guess Athena's coming from that angle and saying that the longer you stay with us, your interest rate will drop because your loan to value ratio will drop. So, on day one, if your loan to value ratio is 80%, as it reduces, over that 30-year loan period, they guarantee your interest rate will drop. So,
and it's intriguing to me that none of the big four are here. Is that because these guys are obviously chasing business, these four, and the big four are just sitting there saying, well, we have a much more stable, we have a diverse sort of proposal, and if you want us, you can come and get us?
No, I just didn't include them. Some of the majors have got a 1 year fixed rate of 1.99%. I just haven't included them because my slide doesn't allow. But no, they are still definitely, the majors are definitely offering the 1.99, but I think it's only for 1 year. It's a 1 year fixed rate. So they're not out of the market altogether, but mostly and across all lenders, the fixed rate is now, 2.09%. Probably the 2 year fixed rate, for example, which was one of the past year, the 2 year fixed rate has been the sharpest rate on the market. So the lenders were quite strategic in going out there and dropping their rates. And what they were doing, they were actually dropping their fixed rates, not necessarily their variable rates. So they had this whole back book that were probably on a variable rate that didn't get a drop in the market because it's an existing book, but any new customers could qualify, or even existing customers could potentially qualify for the super sharp fixed rates. And there was a stage there where, there was a 4 year fixed rate of 1.89%, which was such a fantastic rate. And it was actually one of the majors that offered it, but it was a very short period. And then, as we're increasingly becoming more aware that rates will start to increase, more than likely by the end of next year, if not sooner, those fixed rates, those 2 year sharp fixed rates are slowly creeping up, and the margin between fixed rates and variable is also closing up. These past few years, with all the declining, the cash rate dropping, the banks were offering sharp fixed rates, but the variable rates were, traditionally 50 basis points, 60 basis points higher than the sharpest fixed rate. Whereas now the fixed rate and the variable rate is, or the sharpest fixed rate and the sharpest variable rate, it's very much aligned. There's not much of a differential anymore. It's quite an interesting time, I guess, to see, because there's a bit of uncertainty as to what's happening.
Well, I mean, it is telling when Macquarie Bank are raising money to invest into their home loan business, being historically probably a higher margin seeking sort of bank, but they see the value in building this book as an open.
Yeah. But and Todd, Macquarie is one of the lenders that will price on loan to value ratios, and they definitely offer some super sharp rates for a 60% loan to value ratio. They'll offer a really great rate. Yeah.
And finally, how often do you think that people, as rates go up, as they're inevitably going to do, it looks like, how often do you think people should be looking at this and like contacting somebody like you to go, what could I get, just so that they don't miss out?
If you're on a variable rate loan and you've been with your existing bank for 2 or 3 years, I can guarantee you are not getting the sharpest rate. Well, I shouldn't say guarantee, but I can pretty much bet my heart on it that you are not getting the sharpest rate out there.
I don't know if betting your heart's better than the guarantee, Betty.
Yeah, exactly. My heart's made better than that. But yeah, so I can bet that your rate's probably not the sharpest rate with that existing lender, and that, you know, there are better rates out on the market. So every 2 or 3 years, you should be renegotiating with your existing bank, and really, you know, doing a price check along with, you know, the same thing that you do with your insurance policies and everything else. You're putting it back to the market and seeing what the market's doing. So the most savviest of lenders are generally doing that, right? Going out there and just checking it out and seeing what's going on.
Because over the last, over the length of a loan, over 30 years, that's like 10 to 100 grand sort of saving minimum, I would have thought.
Oh, yeah, 100%. I have so many of my clients come to me and say, I've been with my bank for, you know, 10, 15, or 5, 10 years, and it's an owner-occupied loan. My loan-to-value ratio is low, and I'm being charged 3.5%. And in this environment, when you could be getting, you know, 2%, you're paying thousands of dollars more on your home loan, or even on your investment home loans, when, you know, you could be using that money to go on a long-awaited holiday or something. Yeah.
All right. Thanks, Betty. That was informative, and I think gives everybody something to go and think about. All right. Next up, Nick, how are you?
Very well, thank you.
So supply chain, what industries are you hearing and seeing like having challenges in their usual supply chains?
We are seeing, you know, quite a diverse impact, and some unexpected ones, and then, you know, some of the sort of usual expected. So obviously the retail, as you talked about, there's some pinch points on certain products and items. But one of the ones that we are seeing a real challenge with is around sort of equipment, being sort of heavy equipment, motor vehicles, and things like that, which is I think a combination of pure sort of logistics, but in a greater aspect, it's actually sort of linking back to manufacturing challenges out of sort of Asian and European warehouses, and then the added challenge of actually getting some of those goods down to Australia.
Yeah, is that because we're at the bottom of the chain, right? There's more importance through Asia and Europe and America for demand, and I'm hearing challenges of people sending things from Asia on containers to San Francisco to get sorted because it's quicker and more reliable and more certain that they will actually then arrive, but having to pay effectively triple handling in some circumstances.
Yeah, like I think that's some stories, and we've got I think Scott Carson. We can talk to some of those.
A special guest
shortly. So I think one of the key aspects there is that Australia is a relatively small market for some of these products as well. So it may not be just the pure shipping logistics that's challenging.
We're the last in the chain.
It's the allocation from manufacturers and the OEMs to you know, provision stock for Australia. You know, you may have heard the stories around people trying to get access to new motor vehicles, and there's, you know, demand or wait lists out to early to mid next year for some models. Again, as your the head, you know, catch line for this webinar about the Chipageddon, where there's been, you know, shortages within some computer chips for key manufacturing componentry, which is just causing delays in some of those products. And then
I'll bring in Ashley on that. Ashley, are you seeing those sort of issues? in those family business and your clients?
Yeah, definitely. I think the obvious industry that I'm talking to at the moment that's having issues because of the shortage in processing chips is the IT industry. So struggling to get hardware, big delays to get hardware. But there's also, as Nick said, machinery, car manufacturers are also struggling to get stock as a result as well, definitely.
And the flow and effect from that is that secondhand utes are almost selling at new prices.
Mm.
So because there isn't any stock of the second one. So is staffing still an issue as well that they're hitting in a lot of your clients?
Yeah, staffing's still a major issue. I think the pandemic is, exacerbated an issue that was probably already there before the pandemic. For example, your student visa holders, they're restricted with the amount of hours they can work. They can only work, I think it's 40 hours in the fortnight. So, industries like your cleaning industry, they've got a lot of work on at the moment, but they can only actually employ their staff for, let's say 20 hours a week. And to exacerbate that issue even further, the government's gotten rid of that cap, but only for certain industries. So hospitality, for example. So what we're seeing is staff move from the cleaning industry into hospitality. So it's a
shortages.
It's a structural issue. Yeah.
I think an aspect that's compounding some components of the unskilled labour market at the moment as well is the government's disaster payments, which don't necessarily incentivise some aspects of the workforce to actually participate. So I think speak to some employers, they're hoping with the wind back of those disaster recovery payments over the remainder of this calendar year, we hopefully drive some participation back into the workforce of some people who may be less inclined at the moment for genuine health concerns or otherwise to be participating.
So Ashley, what are people actually doing as practical issues to try and manage these things while this interim period?
That's a tough question. I suppose, I guess for machinery, going secondhand. As a result, the secondhand market's shot through the roof. In terms of staff, trying to do more with less, which is easier said than done. And I suppose the other thing people are doing is I guess planning months in advance. I mean, that's all they can do. So being delayed, essentially.
Getting organised.
Yeah, getting organised. Yeah.
Todd, that might be a good opportunity to introduce Scott Carson. He's the commercial manager at the International Forwarders and Custom Brokers Association of Australia. So I'm really fortunate to have Scott join us today.
There's not many other people who know more about moving stuff around Australia.
No. Scott, you and your members would be at the forefront of trying to keep freight moving in and out of Australia. What's it feel like on the ground at the moment?
Nicholas, look, it's interesting. Look, at least with the supply chain internationally servicing Australia and domestically, freight's been regarded as an essential service. So freight's been moving every day, even across the borders, even with our state border closures. So that's been a really pleasing side of it. And we've seen employment reasonably strong compared to some of the other, industries that have been hit pretty hard. So, the forklifts guys, the warehouse guys, the office workers in the industry, the freight forwarders, customs brokers haven't seen that sort of damage in terms of that situation. But in terms of volumes, it's like a spanner's been thrown in the world's supply chain, and Australia hasn't been cocooned from that. So there's been missed ports of call with some occasions during COVID's peak, which has really hurt importers, particularly because, some of the worst case scenarios, it might be freight destined to get containers discharged in Sydney, and it's ended up getting discharged in Melbourne, and then the importer retailer has to pay the coin to get the trucking all the way up to Sydney and get that distributed. So there's sort of some of the things that have happened. So I guess just in very brief summary, a lot of this is caused by the COVID disruption that's caused in terms of the manning out in the world's major ports that has caused disruption where there's been tools down if there's been COVID outbreaks. There's been a really huge imbalance, the likes of which we haven't seen since containerisation started in the 50s, with empty containers being surplus in some ports and countries and being in short supply in others. As an example, in Australia on the East Coast, we've had surpluses of empties. In China, they've had shortages, so it's working those back into the system. And COVID's also seen a number of ships early on decommissioned, taken out of the system. So there's been less ships sailing around and servicing the industry. And for Australia, little old Australia that sits with New Zealand at the bottom of that ditch, if you like, Asia Pacific, we don't have those captive volumes that we have. And I know you touched on before there, gents, some of those examples with machinery. Well, the US produces a lot of machinery that exports to Australia around the world. China produces a lot of our consumer goods. We do get bumped from regularly in terms of Australia's production because our volumes going at any particular time are less to other parts of the world. So we do feel the effects of that. But having said that, there are some positive things on the horizon as well. There is some pressures on rates at the moment. They may be heading to a plateau situation, air freight and sea freight. They've been at a peak, in some cases up to 500% what they were pre-COVID. More ships are coming into the system slowly around the world and more empty containers are being produced. And if COVID starts to clear the people disruption from COVID, there's some tentative good signs there, albeit a lot of inflation going on from what we see. But there's some tentative early shoots of some positive signs for supply chain frequency and costs.
Scott, that volatility in shipping costs. So you mentioned that sort of up almost 500% from early 2020. I think it is. I've seen some statistics. Is the shipping freight rates normally subject to volatility, and is what's been experienced recently, is that sort of way outside of the norm?
Yeah, well, look, Nicholas, the major shipping lines, they've never made more money. I mean, I don't think they know what to do with it. The revenue and the profits they're making is crazy, absolutely crazy. Now, that's at a cost to particularly the import flow and exports. In Australia, exports, what we mostly export is commodities and bulk, that sort of thing. So those sort of pressures have been there because there's been a shortage of supply of space. Hence, the market has been able to rip and tear and charge whatever the hell they want. Now, that pendulum will swing, and it's a matter of when. We're thinking it might be more likely late next year, early 2023. There's a slight chance it might be a bit earlier than that. There's shipping lines going through a number of them majors, vertical integration, so alliances with each other, two in particular that are even purchasing airlines, that sort of thing that's happening. However, once the market gets some more capacity and once a number of them start to break away and become more competitive, that's when organisations like our members, freight forwarders and customs brokers, for want of a better description, can go through the dynamics of shopping for these rates and getting the better deals. So I'd really, for HLB's clients, I'd really, I guess on a positive note to that extent, really ask them to exercise some caution locking into long-term rates where they are at these levels, because they could come down before their bulk contract purchases expire.
And that was going to be a question of mine. What can an importer or an exporter do in the Australian market at the moment to try and either mitigate their costs in relation to shipping, and or just even provide some security around timing and access to offshore shipping?
Well, Nicholas, what I'd say is probably a bit of advice would be, look, just in time for the moment is pretty much out the window. So running your stock levels skinny is really probably, I'd exercise caution with that. We know a number of importers, particularly through our members, we're hearing where they've primarily been, say, importing consumer goods out of largely China, might be 80–90% of their product. They are working feverishly to look at other emerging manufacturing markets like Vietnam, Philippines, those sort of places, to an extent India, looking for other sources to, if you like, spread the risk, spread the balance. And there's also an increase in stock being held in Australia. So there's significant opportunities there for people involved, and jobs, significant opportunities we believe that are emerging now in the areas of distribution. So import, distribution, warehousing, in-house for large manufacturers and importers, retailers, and through 3PL, third party, through logistics operators. So that sort of space is that'll have some significant opportunities, and that'll continue.
Yeah, thanks, Scott. And look, I assume the message for anyone who is needing to access importing and export is get a good customs and freight broker on your side, and they're going to be working to help you secure the best outcome for the business. Scott, thank you very much for joining us today, and it's really insightful to be sharing the on-the-ground insights with our clients.
I think it tells me why the price of a 2x4 has gone up from $3 a metre to $9 a metre, if you can get it.
And some of those empty shelves at Bunnings, and when you go in on, when you venture in there on the weekend, yeah, it does explain. There's certainly been, look, the stock shortages, we predicted that would happen. That's out there now from a retail and wholesale perspective.
The building industry struggling to get wood, like that's going to have a massive flow-on impact.
And in price as well, Todd, too, because it'll become captive in some areas, particularly some of those new developments that are must get a certain type of, whatever it is, cladding or finishes or things like that. So that's certainly happened. That'll end up washing out, but those shortages and the prices you might have to pay could hurt for a while. Yes.
So we could have that inflationary pressure of that pricing on top of that. And
Absolutely.
then the wave will break and it'll come back down. That's what the RBA is, I think, hoping for.
Yeah. So we've seen inflationary pressures in our little part of the world, that funnel called supply chain. It's been bubbling along for more than 12 months with costs. All the international component, the domestic component, unfortunately, has had to remain under pressure because it's a very competitive market in Australia. There's a lot of freight moves around, but there's a lot of organisations that service it. Unfortunately, with the shipping, what's also happened, we saw with the ACCC's recent issue of their annual stevedore monitoring report, COVID's really exposed that we've, to some extent, sold off the farm. Yeah, we've got different layers of state government and privatised bodies that sit between layers of stevedores and those sort of areas, and it becomes very difficult to have any form of influence on what they charge, their service levels, that sort of thing. So there's to be some interesting assessment from that report flowing forward. But COVID's certainly exposed. We've sold off a lot of stuff that state and federal governments don't control, and state governments and federal governments don't always work together to resolve these things. Really?
No, politicians are always out for the best interest of everybody.
It's an excuse if one's, of different ilks, but the ones of the same ilk, you'd think you'd be working together. So look,
if they're building houses at the moment, they'll be making sure that these things start to get solved.
So it's not all bad. It's not all bad. In the medium term, it's medium term onwards. We think there might be some good news flowing through.
And Tanya, I think we have a graph which just finishes off this conversation nicely. I think that's in our presentation. So, I mean, this gives that indication of where it's come from, and I don't think it's going to change in the near future.
I think that just shows that 500 times increase in 500% increase in shipping costs. So Scott said, hopefully that will soften, but it is obviously need to be factored into all of our importing and exporting.
Well, it's the upside of being isolated and the downside of being isolated. That's just par for the course. And you're right, Scott. We tend to send things in a big ship because we send it as an ore or whatever else is the majority of our stuff going overseas, and that limits the ability to be able to return things in the same sort of format.
Yeah, and just to add to that, that's very relevant, Todd, that in Sydney, particularly as a port, it's really more of an import port than an export port, even well pre-COVID, because of the fact we don't make a lot of stuff these days, apart from bulk materials, agriculture, coal, those sort of areas. But I'm looking at some statistics now just on my other screen here, and in the port botany alone over the last 6 months, total imports exceeded total exports by 14,000 TEUs. That's 6 months, double that if it was rolled out for 12 months, 28,000 TEUs. That's 20-foot equivalents, meaning a mix of 20-foot and 40-foot containers, but if you assume they're all the equivalent of 20s, so over a year, if you projected that over a year, an imbalance of 28,000 containers. So you can see where that empty container pile-up starts to occur, and add some COVID-based disruption, and you've got a recipe for container parks and terminals spilling over with empty containers that China wants.
And we have a client down there, so I've been down the back of there. It's not a place that you go unless you're actually going there. And then when you're going down the back there, you see all those container parks and you go, well, are these things ever going to move? And I think some of them haven't moved for years and don't ever look like moving.
Yeah, and look, and there's not a lot of money. The reality is in holding empty containers and moving empty containers, that's in that small piece. The money to be made is in filling them and getting them and filling them up for import or export. So therein lies part of that logjam. So that's why it'll be a little bit artificial in a way, but there's a lot of empty containers being manufactured. China manufactures 80% plus of them. So in the end, there'll be a surplus of empties, but at least the capacity is slowly starting to be fed into the system, the same as the additional ships coming into the system is occurring now, slowly.
Time to be a billionaire ship fleet owner.
Or some tech stocks, maybe.
Two ends of the spectrum, Scott. Two ends of the spectrum. So we'll give a quick update on succession from Ashi. So what are the family businesses and the families that's sitting behind them? What are they sort of thinking at the moment, and how are they moving through this sort of process?
Yeah, so I think succession is still a pretty hot topic with most family business owners. I suppose with succession, you could either sell the business, or you could transition it to a family member, like a child. I suppose whatever, direction you take, I suppose most business owners find that it takes a hell of a lot longer than you anticipate, and it's a hell of a lot more complex than you expect. I think that we're going to see increased demand for succession planning over the coming year. I've had a number of clients, get in contact with me, concerned with the level of debt that the country has, and concerned that is the government going to change the rules on them regarding, estate taxes, for example, and, CGT concessions, things like that.
State taxes, they're a monumentally popular sort of thing to bring in.
Yeah. They're not popular, but,
necessary.
Yeah, potentially.
GST is going to go up before that, surely, though.
Yeah, you would. Yeah, you would think so. We've also got, the franking credit issue, which is also a very coveted piece of, legislation that's very unique to Australia. A lot of other countries don't have that benefit. So yeah, a lot of business owners, I think, are increasingly aware of some of the advantages that they have at the moment, and are starting to, I guess, plan for just in case.
So potentially there's a distribution or a wealth transfer down generations to try and protect the position.
Yeah, exactly right. Maybe it's not the best idea to wait till they're deceased to pass it on. Maybe they should do a piece of that puzzle now and not wait for that.
Or at least plan for it.
At least plan for it. That's right.
And that leads into Guesty. Are you seeing that sort of like people buying businesses to expand and also doing transactions around those type of things to try and get out in front?
Oh, look, I think it's a great alignment at the moment of those businesses who in the trade space who have access to relatively cheap debt and of a willingness to expand. And I think with the back end of the pandemic, hopefully here there's some sort of normalization on transactions terms, and we're seeing a real significant increase in demand for acquisitions. And
that's people chasing growth because they find it hard to do it.
Yeah, absolutely. Yep. And growth makes sense by acquisition at the moment when your cost of capital is relatively low. We're also seeing a large amount of money in private wealth who are an investor group which is willing to again look for growth and deploy some of their cash, which is getting relatively low returns in a bank. And I think that aligns with Andrew's talk about some business owners who, for them, operating a business through the pandemic hasn't been easy for some. While the business itself may have travelled okay, there's a significant amount of risk and concern that remains with those business owners. And the opportunity to exit their business via a sale, which is something they may have always thought was down the track. We're seeing that 2022, and particularly early 2022, may be a great time for that to progress.
And do your exploration now and then land the fish in early new year.
Yeah, and I think for those reasons Andrew said, being prepared, having some optionality in your decision making, whether that be to continue to run your business successfully, pass it on to or succeed it to an internal management team or family members, or potentially explore an external sale. Each of those entails some planning, and doing that planning early. It's going to have to happen at some stage. If you get onto it, have some succession plan discussions. It puts you in a really good place to be able to take advantage of some options when they do present themselves.
And that leads me into getting Hock to, before Tanya gives me the real wind up, to like with these supply chain issues, the energy costs and staff issues, some people are going to be not going to be able to deal with them very well. So how should they be dealing with those challenges? Should they be talking to Guesty about selling?
Look, quite possibly. I guess even talking to Nick just about reviewing, their business plans and their strategic plans so that they've got a clear direction about where they're going in 2022. Doing what you should do when things are a bit volatile, look at your reporting framework and your forecasting, and really looking at, these changes in your probably key cost drivers due to supply chain, staffing, high energy costs that have occurred.
So changing your margins or changing your pricing to reflect that, right? Even if it is in a short-term scenario.
Well, just probably looking at your forecast and always adjusting it, given that we're going to have a bit of volatility, or probably the word for 2022 will be headwinds impacting us. So
we're going to leap into the headwind, are we?
We definitely are, and it's probably going to be a word that people are over with by the end of 2022. But I think overall that it'll be a positive outlook for 2022. I think the RBA's I guess board announcement in November was quite positive, and there's no reason to suspect otherwise. Whilst there's a few things around that are a little bit concerning, it should be a positive year, and with Australia having a high vaccination rate, I think the instability and having more lockdowns is hopefully unlikely. So it should be a better outlook when moving forward.
So you're looking forward to actually watching a game of AFL live?
Yeah, no, I can't wait. Or even going home to Adelaide would be great. So, hopefully it's positive. And I guess probably one of the major things in what Scott, focused on around, managing your working capital closely. So watching your cash, realizing that just-in-time ordering your stock probably isn't going to be possible for a little while, and that you're going to have to adjust your forecasts and adjust your management of your working capital to reflect.
And your customers. So you're going to have to effectively work with your customers a lot tighter to be able to say, if you want this, I will buy it, but this is how it works.
Well, yeah, I guess driving the relationships and also your debtors collection policies, and you might have to be a bit flexible so that you are managing your cash more efficiently. Whilst you're having to kind of juggle, having to probably put more money out the door so that you've got more stock, just so that you can make sure that you've got it.
But have the right stock at the right time at the right price.
Well, that's right. I mean, we've seen just in the hospitality industry, just not moving off stock, but there's been a lot of restaurants that, whilst they're ready to go and they've bought all their stock and they're pretty excited to get open and bring people back, they just can't find people, and they've had to be closed for a period of that, which is just, it is what it is. And hopefully with international students and workers coming back, that will improve things. But I can imagine some business owners will be quite frustrated over the next few months, not being able to maximise their revenue.
All right. On that note, I think I've now been given the official wind up. So these are some of the things that we think people should be doing. And the outcome of today, I think, sort of reinforces that. Watch the economic data and contemplate how that may impact. So I would be watching labour rates, and also GDP comes out shortly, and just seeing how that's going. But I suspect we're going to have that big leap and jump that we're going to get now. The bigger issue then is working out how to get through Christmas, and then what the impact's going to be early next year to the back end of the year as this supply chain issue probably comes through a bit more. Then the other thing I would be doing is looking at the bargains and the sales across November. I think that's another way to drive the economy, and working through how you can spend your money the best to get the most bang for your buck. And some of the offers available already are pretty ridiculous, and they're probably only going to get better. If you have any queries or issues, reach out to one of our guys, and we can put you in touch with guys like Scott, who can help you with the real issues that underline you around supply chain and the specifics that you have any queries on. And we're happy to have a chat. So I thank you all for coming along and listening to us ramble on, and Scott giving us some real insight into what's going on in the real world.